Thank you for the opportunity to speak with you today about a very important topic, one that's very close to the bank's objectives, of course, inflation, wages and the labour market. Before I sort of get into the details, though, I did want to thank you as economics teachers as well. I'm currently involved in recruitment for the bank, and we take a steady stream of high calibre students from universities. Of course, exposure to economics for many is the first exposure is in high school economics, and students going through high school want to be a lawyer or a doctor or maybe an astronaut. Economist is often not the sort of leading choice, in part because no one really knows what economics is until they do maybe year 11 economics for the first time. It was certainly my experience at Henley High School in South Australia. Hadn't heard about economics until year 11. I was a slightly disillusioned student, just to put you at ease. I wasn't a disruptive one, but wasn't sure where I was going, and economics was probably the first subject that I did that I thought, actually, this is something I'm interested in, and that was a little while ago now, but that set me on a path that has ultimately led me to a very fulfilling career at the Reserve Bank and the opportunity to talk with you today. So I'm very thankful for that, and thankful for Mr. Thomas, who was my economics teacher in year 11 at Henley High. So in terms of today's topic, earlier today, Lucy Ellis summarised current economic conditions with a strong focus on developments in inflation. The range of shocks that have buffeted the domestic and global economy over the past 2 years help explain why inflation is high. My colleague Lynn will talk more about some of the global backdrop in the next session. In the workshops prior to this one, some of you discussed inflation with Thomas and others discussed labour market developments with James. I'd like to build on these sessions by highlighting how the success in navigating a course back to 2 to 3% inflation will depend on the connections between inflation, wages and the labour market. How households and businesses respond to the temporary increase in inflation and their expectations for future inflation will also be important. So starting with this one, which I know you saw earlier, consumer price inflation in Australia has picked up markedly since the middle of 2021. Headline inflation in purple is as high as it's been in decades, and is in fact forecast to be around 7% in the second half of this year. Underlying inflation in orange has risen strongly and is also forecast to increase further in the second half of 2022, largely reflecting further pass-through of upstream cost pressures. But from the first part of next year, inflation is expected to start to decline back towards the 2 to 3% range. So one of the ways we can get a better understanding of inflationary pressures is to break the consumer price basket down into its components. As some of you discussed with Thomas, at the most detailed level available from the ABS, there are 87 expenditure class items. As you can see from this graph, which breaks down quarterly CPI inflation by a few of the bigger contributions, a small handful of items account for much of the recent increase in headline inflation. For example, price increases for newly constructed dwellings and automotive fuel, which together account for about 15% of the CPI basket. These two items account for close to half of the increase in headline CPI in the March quarter. Relating recent developments to inflation to the textbook, we can see both a role for cost push inflation and demand pull inflation. But it's hard to be definitive about which of these matters more. And in fact, there's a wide range of views amongst economists about their relative importance. We'll talk more about this now. What is clear is that the pandemic-related supply-side problems in the global economy are gradually being resolved. As mentioned, Lynn will talk more about this in the next session. But one point I want to emphasise is that for inflation to stay high, prices have to keep increasing at an elevated rate. In many cases, we're seeing upstream price pressures or prices already stabilise. So the rate of inflation for these items will fall to zero. In some cases, we're seeing upstream prices decline, giving a negative rate of inflation for these items, or deflation. For example, higher oil prices mean that petrol prices have contributed to inflation for several quarters in the orange bars. This is likely to be the case in the June quarter as well, but this contribution to inflation can't happen indefinitely. If oil prices stabilise, as has been the case in the last few weeks, fuel prices will eventually remain at a high level but no longer contribute to inflation. For consumer price inflation to be sustained at an elevated rate, there needs to be feedback between price increases in the economy. That is, high prices in one part of the economy are increasingly passed on to creating second-round price increases. In particular, higher prices leading to higher wages, leading to higher prices, and so on, can be a very damaging feedback for the economy. As we'll see shortly, though, this sort of wage price feedback isn't necessarily evident in the Australian data. But it is the case that upstream price pressures and strong demand for goods and services have led to a broadening of inflationary pressure in many countries, which is one of the indications that second-round price increases are becoming more common. So in this graph, you can see the share of items with annualised price increases of more than 3% is at its highest level since 1990. Information from our colleagues in the Bank's Liaison Program indicates that upstream price pressures are increasingly being passed on to consumers. As we move forward and some of the upstream price pressures from offshore developments start to moderate, the tighter labour market in Australia is expected to become a bigger driver of inflation outcomes over the next couple of years. Inflation is expected to return to the top of the 2 to 3% range over the next couple of years, but the path back here will partly depend on how wages respond to the tightening in the labour market, and also how households and businesses respond to the elevated rate of inflation, in particular how their expectations of future inflation evolve. So let's look at these two forces in turn. So the labour market bounced back from the pandemic shock surprisingly quickly. The unemployment rate in blue in this graph is at a near 50-year low. 50 years. Another measure of spare capacity in the labour market is the underemployment rate. That's in purple. And this is people that want more hours but can't currently get them. And related to the considerable decline in this series that you can see over the past year is the very strong growth in full-time employment. Full-time employment's already 6% above its pre-pandemic level, while part-time employment's actually 1.5% below its pre-pandemic level. The relative strength in full-time employment is another good indicator of the underlying health of the labour market. The underutilisation rate, which is the green one here, adds together the unemployed and underemployed series. That's at 9.5%, which you can see is the lowest level since the 1980s. So across sort of any of these measures, we can see that labour market conditions are the tightest they've been in a long time. And we know from a number of other indicators that labour market conditions are very tight. So two of these are shown here. Many firms report that the availability of labour is a significant constraint on their ability to operate and expand. So the orange line here is from the NAB survey, shows the number of firms that report that finding suitable labour is a severe constraint on output. And you can see that series is as high as it's been in decades. Close to half of firms in the survey report this as an issue. The level of job vacancies is also very high at a time when the participation rate and the ratio of employment to the working age population are already very high. So as a result of the tightness in the labour market, it's clear that labour cost pressures are building. In this graph, growth in the wage price index, shown in red, has started to pick up, as have broader measures of earnings growth, such as average earnings per hour, shown in blue. The difference between these series, or one of the differences between these series, is that average earnings incorporates a broader range of payments to labour, overtime payments, bonuses, whereas the wage price index is more of a pure wage inflation measure. So at the time of the May statement, which is where these forecasts were framed, we forecast further increases in wages growth over coming years. Indeed, it's now the case that a broad base of evidence points to further growth in wages. The recent Fair Work Commission decision on minimum wages and award wages. Secondly, a large share of liaison contacts are reporting they're paying larger wage increases or that they expect materially higher wage growth in the period ahead. And business surveys are also pointing to a pickup in labour costs. Even metrics on job mobility, so the amount that people are moving between jobs, have picked up. And this is also consistent with increased wages growth. But there's still a significant degree of uncertainty about how aggregate wages respond at low rates of unemployment. This uncertainty is partly because of the lack of recent historical experience. In the past 4 decades, the only time that Australia has had an unemployment rate close to 4% was briefly during the peak of the resources boom. So to address this sort of gap in our understanding, 2 of my colleagues at the bank, James Bishop, who many of you just met, and Emma Greenland, have increased our understanding by using evidence from local labour markets around Australia. So what they've done is looked at the relationship between the unemployment rate in nearly 300 individual local labour markets and compared that with the average increase in labour income in these markets using tax office data. So the vertical axis in this graph shows how much growth in income in particular labour markets varies from average, when the horizontal axis shows the unemployment rate in each of these labour markets. And you can see from the graph that the relationship is not particularly strong at higher rates of unemployment. But once we get below 4%, income growth starts to increase much more strongly. So the path back to an inflation rate of 2 to 3% will also depend on how households and businesses respond to the elevated rate of inflation. We know from past inflationary episodes that if an inflation shock shifts people's expectations about the ongoing rate of inflation, it becomes harder to reverse. It's important that the higher rate of inflation this year does not feed through to ongoing inflation expectations. If it did, this period of higher inflation would persist and it would be more costly to reverse. We can get a sense of this risk from household and business inflation expectations measures. So measures of short-term inflation expectations have increased substantially in recent months to be at their highest level in many years. This is not surprising given the very high prices for some of the common items we buy, including petrol. But to date, longer-term measures of inflation expectations have been well anchored at around 2 to 3%. So we can see a range of these measures in this graph. In the top panel, we have expectations of union officials and also 2 different measures of market economists' expectations. In the bottom panel are measures we derive from financial markets. And taken together, these measures give fairly substantial evidence that people believe will get inflation back to target. So we've looked at some of the key drivers of inflation: supply shocks, their impact on upstream prices, strong demand we can see through the labour market and wages, and inflation expectations. Ultimately, what we care about is where inflation will be over coming years. We won't know about inflation in the June quarter until later this month, but there's already nothing we can do about that. We can use information from the past to help us understand how the economy might respond in the future and set policy accordingly. So there are a few historical episodes in Australia's post-World War II experience with inflation that stand out. Most recently, it's been the sustained period of low and stable inflation that has characterised the inflation targeting era. This stands in stark contrast with the 2 periods of particularly high inflation, the first in the early 1950s and the second in the 1970s. So in the first of these, the late 1940s, the shift back from wartime footing posed some adjustment problems for many countries that have been involved in the war, including in Australia. There were big shifts in production and government controls of prices and wages were removed. Some economists have argued these adjustments have parallels with the effects of the recent lockdowns in response to the coronavirus pandemic. So following this reopening, the Korean War broke out in June 1950 and led to a sharp spike in wool prices. At the time, wool was Australia's major export, and export receipts surged 60%, fueling a massive boom in domestic activity. Coming on top of already high inflation, this stimulus pushed inflation up sharply, and very sharply, as you can see here. Inflation peaked at close to 25%. But this boom passed quickly. Wool prices collapsed, fiscal policy tightened substantially, and inflation rapidly retreated. This was a long time ago, but demonstrates that very high inflation does not necessarily mean sustained inflation. Australia also saw a big rise in inflation in the mid-1970s, along with many other countries. As our former Governor Glenn Stevens once remarked, what was remarkable about the mid-1970s was not the magnitude of the rise in inflation. This was not unprecedented at all, as the 1950s demonstrates, but the fact that high inflation persisted right through to the early 1990s. Other countries had difficulty in combating inflation too, but Australia's performance with inflation deteriorated relative to other countries. It went from being a relatively low inflation country in the 1960s to a relatively high inflation economy in the 1980s. So it's not surprising that this episode has been talked about a lot recently. So taking us back to the 1970s now, Australia entered the 1970s with significant momentum. So on the left-hand side, I've got activity and unemployment, real GDP per capita and the unemployment rate, and the right-hand side, earnings growth and inflation, which I'll talk about in a moment. We can see in the left panel, though, that the significant momentum the economy had coming into the 70s. So a mining-led export boom in the late 1960s was underway, and domestic demand was booming. So you can see real GDP per capita here growing at 4% annually. These are phenomenal rates of growth in a single year, but this was year in, year out. The unemployment rate had been around 2%, for much of the period since the Second World War. So on the right-hand side, we can see that wages growth was, or earnings growth was also growing very strongly. So early in the 70s, average weekly earnings were running at roughly 10% a year. Again, sort of different magnitude of growth rates to what we're now used to. Wage setters didn't really give too much attention to the inflationary impact of wage setting. Inflation just hadn't been much of an issue for many years. But then on top of this booming economy, we add into the mix a global oil shock in 1973, where the price of oil roughly quadrupled. This was the first of two major oil shocks that decade. And also a time when the economy was much more dependent on oil than is the case today. So the increase in world oil prices generated a very high rate of inflation, which was then made worse by domestic wage pressures. So as we talked about, and wages growth was already running at, wages or earnings growth was already running at a very strong rate in the early 1970s. This was followed by what some referred to as the 1974 wages explosion. Average weekly earnings increased by more than 25% in 1974. 25%, sort of way above, and that was an average, way above the rate of inflation. So you can see the female average weekly earnings in light blue, male average weekly earnings in dark blue, and the scale of this graph is something that we're just not used to in current times. But yeah, key point is the rate of growth relative to inflation in that mid-70s period. So a few factors contributed to this very strong rate of growth in earnings. So there's the strong activity and labour demand conditions, which we've talked about. Expectations of inflation were also very high, in part due to the oil shock. The third factor was the upward adjustment in female wages following the equal pay case that introduced a single wage rate for a job regardless of gender. Obviously a very important adjustment, but one that led to that additional growth in female wages or earnings that you can see in the graph. And fourthly, institutional features meant that a large wage increase in one sector, specifically the metal trades workers, subsequently flowed through to much of the rest of the workforce. So the centralised wage setting process at the time then introduced wage indexation in 1975, where increases in the CPI were then fully passed through to nominal wages. So you can see the effect this had. The two become quite, earnings and inflation become quite closely related because of indexation. So the problem with indexation was that the level of real wages was locked in at a level that was way too high. You can see after a nominal increase that was well beyond the rate of inflation, real wages had increased substantially in 1974. And then effectively through indexation, this was locked in. The rise in real wages relative to productivity in Australia stood out quite distinctly in international comparisons of the time. So significant increases in the cost of production, combined with reduced demand from other economies that were also entering recession, caused output to contract and reduced Australia's firms' ability to employ workers. You can see the unemployment rate back on the left-hand panel rose sharply to around 6% over the second half of the decade. 6 doesn't sound sort of too high by our standards today, but at the time, following an extended period of inflation, unemployment around 2%, really was a dramatic increase in the unemployment rate at the time. And so despite falling output on many occasions through the decade and rising unemployment, there was sustained high rates of inflation. And I guess the combination of these variables is typically a situation referred to as stagflation. So the 1970s are a cautionary tale for policymakers. But I'd argue ultimately there are more differences between the current outlook and the 70s than there are similarities. An important one is that public policymakers have learned what not to do from this period. We know there are serious consequences for letting wages grow well beyond the rate of productivity and inflation. Our institutions are more flexible and allow adjustments to occur much more easily. A very important difference between the current episode and the mid-1970s is the floating Australian dollar relative to a largely fixed regime at the time. Monetary policy can also play a more active role in ensuring there's a sustainable balance between demand and supply of goods and services in the economy, other than that inflation expectations remain well anchored. Inflation will not become self-sustaining with price increases leading to wage increases, leading to price increases if people are confident the Reserve Bank will take the necessary measures to bring inflation down over time. So to conclude with a few points, inflation is high and expected to increase further in the second half of 2022. High inflation damages the economy, reduces the purchasing power of people's incomes and devalues people's savings. It's costly for businesses to manage more frequent changes in prices, and the uncertainty of price changes is another cost for businesses. High inflation makes it harder for households and businesses to plan with confidence. And so the bank's board is committed to doing what's necessary to ensure the rate of inflation returns to 2 to 3% over time. So by early next year, we expect that inflation will begin to decline. The pandemic-related supply-side issues are being resolved. And another factor that provides confidence is the tightening of monetary policy that is underway around the world, including here in Australia. Higher interest rates will help to create a more sustainable balance between the demand for goods and services and the ability for our economies to meet that demand. We know that medium-term inflation expectations remain well anchored at 2 to 3%, suggesting that people believe we'll get back to target. It's very important this expectation remains the case, as the look back to the 1970s highlights. Higher interest rates can also directly affect expectations by demonstrating the commitment of the bank to return inflation to target. So thank you for your time, and I welcome questions and discussion.